Energy tensions, higher real yields, and a historic wave of AI spending are pulling equities in different directions right now. This is vTalkInsight, Equity Pulse Daily for August 12, 2026. Let's unpack how oil, rates, and AI financing are reshaping the equity backdrop as markets wait for the next round of U.S. inflation data. Global equities are trading against a renewed energy shock, with Brent crude hovering just below $90 a barrel and West Texas Intermediate close to 85. The move is not just about demand. It reflects mounting geopolitical friction around key choke points such as the Strait of Hormuz and Bab el-Mandeb. Escalating tensions between the United States and Iran, continued naval blockades, and even reports of an attack on a vessel trying to breach the blockade all underline how sensitive oil is to any Gulf headline. Despite the security presence, so-called dark ship-to-ship transfers are still taking place, which shows that supply is flowing, but with a growing risk premium attached. The inflation risk is amplified by a U.S. strategic petroleum reserve sitting at a 40-year low, limiting the scope for a quick policy response if supply is hit again. In Europe, diesel prices are up about 10% this year, and gas prices have surged roughly 120%, while heat waves and low river levels squeeze both power generation and agriculture. On top of that, Ukrainian strikes on Russian refineries and Black Sea ports threaten both fuel and grain flows, and El Niño is expected to inject more volatility into global food prices. Bond markets still appear complacent about a potential food price shock, so this week's U.S. consumer and producer price data become crucial checkpoints for whether inflation surprises reemerge just as equities have been consolidating with the VIX in the mid-teens. Against that energy backdrop, U.S. Treasury yields are grinding higher again, with the 10-year approaching 4.7 to 4.8% and the 30-year edging above 5.2. Importantly, much of the recent move reflects higher real yields rather than inflation expectations, which tightens financial conditions even before the Federal Reserve makes another move. Fed officials are signaling that more than one further rate hike may be needed to contain persistent above-target inflation, and markets still see better than even odds of a September move. At the same time, if core inflation were to undershoot in the upcoming data, investors could quickly price out a near-term hike, especially with labor markets no longer red-hot, so the policy path is unusually two-sided. Longer term, persistent fiscal expansion is keeping pressure on yields, with U.S. net interest payments now exceeding defense spending and bond buyers expecting some form of fiscal adjustment within the next 5 years. A strong dollar, supported by robust U.S. macro data and policy divergence with a still cautious Bank of Japan, reinforces that higher yield environment, raising the hurdle rate for long-duration growth equities even as earnings stay strong. The most powerful counterweight to tighter policy is the sheer scale of the AI investment cycle. Data center capital expenditure by the major technology firms is projected to exceed $1 trillion this year, surpassing even historic peaks in U.S. defense spending and marking the largest private build-out on record. Nvidia sits at the center of this, having assembled a coalition of 6 major financial institutions, including Goldman Sachs and KKR, to mobilize up to $500 billion of financing for AI infrastructure. The structure effectively treats Nvidia GPU clusters as collateral, allowing loans secured against compute hardware rather than just borrower credit and turning AI chips into an investable asset class. Banks and asset managers are exploring asset-backed products that would package AI hardware loans in a way that resembles aircraft leasing or auto and mortgage securitization. That could broaden investor access to AI exposure, but also introduces leverage, and the emergence of a securitized GPU market is already raising concerns about concentration, bubble dynamics, and how these structures might behave in a downturn. Some early signals are flashing amber. Nvidia's credit default swaps have widened by more than 20 basis points versus hyperscalers like Amazon and Microsoft, even though its equity remains well supported. CoreWeave is growing fast but generating roughly a 1% return on assets while paying close to 10% for funding, and neocloud providers more broadly face similar negative spreads and heavy reliance on a handful of hyperscaler customers. The cost of credit is already changing behavior, with Intel shifting from debt towards large-scale equity financing for AI capex and a surge in tech sector bond issuance helping to nudge Treasury yields higher. If AI demand and pricing power stay as strong as today, this leverage can be absorbed, but if utilization or margins disappoint, the same structures that accelerate the boom could amplify any unwind across both equity and credit markets. For now, corporate performance is more than offsetting macro headwinds. In the United States, S&P 500 earnings growth is running around 28% excluding tech and roughly 32% including it, with 10 of 11 sectors showing positive profit growth and 9 delivering double-digit gains. That breadth is visible in price action too, with the equal weight S&P 500 recently making new highs and Russell 3000 earnings per share at multi-year highs. The narrative of an index driven only by a handful of AI champions is being challenged by strong contributions from financials, industrials, healthcare, and energy. European equities are also surprising to the upside, with second quarter net profits up about 17.5% versus consensus expectations near 11%, the strongest quarter since 2022. Banks are favored into year-end on better purchasing manager indices, robust earnings, and the prospect of another European central bank hike, while energy stocks outperform as Brent approaches $90, even as travel and leisure names suffer from higher fuel costs and geopolitical uncertainty. Within technology, software is increasingly the relative winner as cheaper models and open-source tools allow firms to monetize AI without paying peak prices for hardware, and software-focused exchange-traded funds have been outperforming semiconductor peers. Options volatility remains elevated in tech, but skew is flattened as investors concentrate on upside calls rather than downside hedges, signaling renewed appetite for participation in any further AI-led rally. Positioning data suggests significant dry powder. Institutional exposure sits only around the 37th percentile, and systematic strategies that de-risked in July are reportedly preparing to re-enter with leverage as long as earnings stay resilient. Yet many discretionary traders are in a holding pattern ahead of the inflation data, with indices little changed and the VIX around 15, even as option markets price a pickup in volatility into Nvidia's next earnings and the Jackson Hole Conference. At the company level, the AI infrastructure theme is showing up well beyond the obvious chip names. Vertiv just delivered a 60% year-on-year increase in earnings per share and raised full-year guidance, citing a strengthening pipeline for power and cooling equipment, while keeping its product roadmap flexible enough to support both legacy and next-generation data center architectures. Specialist supplier site time has seen triple-digit revenue growth and a roughly 90% share price gain this year, helped by timing solutions that are critical for AI data centers but also used across automotive, industrial, communications, and consumer markets. Its chips are built on mature process nodes, reducing supply chain risk, and retrofit products allow customers to upgrade existing facilities rather than rely solely on greenfield projects. GXO Logistics reports strong growth in data center-related supply chain work and tangible productivity gains from AI tools, with some clients seeing about 50% better picking efficiency and a 2-year payback on humanoid robots. Supermicro has guided first quarter net sales well above consensus and continues to benefit from pricing power in AI servers, while Riot Platforms is pivoting from Bitcoin mining toward a $9.1 billion multi-decade AI data center deal with Anthropic. By contrast, CoreWeave's thin returns and high borrowing costs underline the financing risks in the neocloud segment, and in Europe, UBS remains in focus as Swiss lawmakers debate stricter capital rules that will shape the bank's future dividend capacity and strategic flexibility. Putting it all together, equities are caught between 3 powerful forces: an energy and food backdrop that keeps inflation risk alive, a rate and fiscal regime that is pushing real yields higher, and an AI-driven earnings and capex boom that is still gathering pace. So far, Broad-based profit growth in the United States and Europe, constructive positioning, and strong AI-related demand are offsetting tighter financial conditions, even as credit markets start to question some of the most leveraged parts of the AI infrastructure stack. From here, the key signals to watch are the upcoming US CPI and PPI prints, any escalation in Gulf shipping disruptions or food supply shocks, the evolution of Nvidia-linked financing structures and credit spreads, and regulatory outcomes, such as the UBS capital debate, that can reshape sector narratives. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.